The Retirement Cafe Podcast, episode 98, ESG Investing with Vanguard's Mark Fitzgerald.
Retired or thinking about retirement? You've come to the right place. Welcome to the Retirement Cafe Podcast. In each episode, we bring you an important conversation with insight, tips and knowledge, all designed to help you live a fulfilling and successful life in retirement. Here's your host, Chartered Financial Planner and accredited later life advisor, Justin King.
Hello and welcome to the latest episode of the Retirement Cafe Podcast, which is sponsored by My Financial Planner. Not knowing when you can afford to retire or what your pensions will provide can be worrying. My Financial Planner provides independent, fixed-fee retirement planning advice, bringing clarity to your financial future. At My Financial Planner, we build a financial plan for your retirement and equip you with the knowledge to implement the plan and, if necessary, buy any products you need yourself rather than us selling you pensions or investments. Find out more about getting a plan to fund the retirement you really want at myfinancialplanner.co.uk. This week on the podcast, we are discussing a topic that I've noticed becoming more popular over the past few years. The topic of investing in environmentally or socially responsible companies, otherwise known as ESG investing. It's something that I'm asked about more frequently now than ever before, and it's a hugely complex topic. So I thought it would be a good idea to dedicate an episode to the subject and invite one of the leading experts from Vanguard to share his knowledge. Mark Fitzgerald is Head of Product Specialism at Vanguard, one of the world's largest asset management companies. Vanguard pride themselves on taking a stand for investors by uniquely, in the fund management arena, being owned by their investors, which means that they redirect profits to their investors in the form of lower fees. You may like to listen back to episode 41 with Head of UK Sales for Vanguard, Neil Cowell, who shares the company's story and approach to investing. But today, we're focusing on ESG investing, so I hope you learned something new from my conversation with Mark. So welcome to the Retirement Cafe Podcast, Mark Fitzgerald. Hi, Mark.
Hi there, Justin. How are you?
Yeah, very good, thank you. Really pleased that you could join me this afternoon. So, Mark, for those who don't know who you are, can you tell me a little bit about yourself?
Yes, certainly. So I work for a company called Vanguard. It's an American asset management company. Some of the audience may have heard of us, but my background was actually fund management. So for a competitor for many years, actually running portfolios. And then a few years ago, I decided to switch over, join Vanguard, and principally talk about the products rather than manage them anymore. Right.
Fantastic. Now, this afternoon, I've tasking you to explain something called ESG, that is like the big terminology in the world of personal finance at the moment. Now, ESG stands for environment, social, and governance. But tell me what it means from Vanguard's perspective.
Yeah, it's very topical, Justin. We're having a lot of conversations at the moment with ES and G. The thing is, the letters are not fully understood because there's no industry definition. And so you always have to, when someone sort of starts to talk about ESG, do what you've done and essentially say, well, what does that mean? Or at least what does it mean to you? So the way we start off is just thinking of the E, that's the environmental side. S for social, so maybe how a company treats its customers and its the people that work there, and then G is governance. So that could be how the company's managed. The board structure, that sort of thing. So these are there are dozens and dozens of factors that we could go into that describe the E, the S, and the G. The main thing is okay, well, what does an asset manager do with that, and how do we create products that then investors can buy, and how do those investors know which ones to choose? Because just because it's got ESG on the label doesn't mean to say that two products are alike.
So just taking a step back, when we talk about investors, of course, we're talking about the population at large, and a lot of the population may not think they are investors, but often they are because they've got pension funds, or they may be auto-enrolled, or you may be drawing down your pensions in retirement. So straight away, you are in our world classed as an investor. And then, of course, those investors have some choice over the funds that they invest in, don't they? And they can invest in the UK in a FTSE fund, FTSE 100, or they can invest in the Dow Jones, or in the US, or they could invest globally, couldn't they? And then there's, of course, so what we're really doing is we're looking at the universe that you can invest in. And then we're kind of narrowing down the framework, aren't we? So that we've now got one of the areas that you can invest in is an ESG fund. Is that the way you see it?
Yeah, and it's a really good way to frame things, because the way we think about it at Vanguard, and we're very closely aligned with investors because we're investor owned. It's just something to bear in mind. We don't have shareholders. We're owned by those people.
Unique.
Yeah, pretty much unique. Yeah, and not something fully appreciated. So when we think about investors, they're our owners. So we're not the traditional sort of asset manager. Now, you're exactly right. So an investor, a person in the street, whether it's buying directly or whether they're drawing a pension, however they choose to invest, they've got to think about what's my objective, what's my time frame, what am I trying to do here? Is it for retirement? Am I in retirement? Is it to buy a car? Is it to pay school fees or university fees? Who knows? People have a wide variety of objectives, but you've got to know your time frame, and then have a sense of how much risk you're willing to bear. Now, we always start from a global perspective. So we would always say be diversified, because that's your friend in finance, diversification. It means you spread your risk. Then you have to make a decision about asset classes, equities, bonds. How do I put those together? So you can make some sort of, often, we would suggest people get advice from an advisor. You can think about these things, and ESG is what comes after you've made some of those pretty fundamental decisions, or you've answered some of those questions. Because what ESG funds are trying to do is apply some filters to the broad universe to take out some securities that maybe certain investors don't want to hold. So let's just say we're thinking to the future, we're concerned about the climate. I, as an investor, may not wish to invest in fossil fuel extraction. And so ESG products could take that one tenet and say, fine, we'll just not invest in companies involved in fossil fuels. That's just one small part. It could be that someone says, I want to invest in companies that are very well governed and maybe have a very strong diversity policy, and maybe are looking to address the imbalances in gender in the workforce. There's a number of different ways you can look at this, but you're absolutely right. It's about taking the broad universe and filtering it down to meet your objectives.
That's right. And why do you think that... I mean, it may be a slightly obvious question, but maybe you've got a bit more data or detail in the data. Why is this suddenly coming to prominence? Why is it the keyword now in 2020 when it may not have been in 2015?
Well, I think that the COVID crisis is one actually sort of tenet that's happening right now, where people are sort of looking at how humans interact with a natural environment. That's one thing, but more generally, we've seen ESG funds and interest in ESG through queries from advisors and institutions and clients really grow over the last few years, particularly the last 3 or 4 years. And part of that is actually down to all the emphasis on climate change. So if you think about the Paris Agreement, that is for most of the countries that have signed up, they've now starting to think about implementing that. You think about it in the UK, these targets that you hear about, how do we go, carbon neutral by 2050, whatever that might mean. Now, these things will have real implications on how we get from where we are to some of these stated goals. It will mean things like phasing out petrol and diesel driven cars, some very real things. It will mean about focusing on your energy mix of how can you choose as a consumer to use a particular utility to provide your electricity. These are real things, and therefore, when you look at the investing world, there will be individuals who say, well, I want my investments to do some of that work as well, because I feel it's the right thing to do. And also, maybe I feel it's a good thing to do financially. Do I want to be exposed to companies that maybe won't exist in the future? So there's a big regulatory push that may not be always apparent for those not deeply into it in the industry, but the rules and regulations are changing, but people's the focus on this and what people want from investments is changing.
Yeah, absolutely. So to give you an example, I had a client that we've recently taken on who had their pension funds all over the place, and with all honesty, probably didn't really appreciate where the investments were held. But when I asked the question about, what types of investment do you want and explain the options available, very quickly, the lady said to me, I want nothing to do with tobacco stocks and I want nothing to do with arms. Those were two things that very much had actually affected her family directly. So, and therefore, she, was like, well, now I've got a choice, because the choice hadn't been put to her by the previous advisor. But as soon as she realized she had a choice, it was quite determined, wow, those are two areas, I don't want to be involved in guns, etc., or arms, and I don't definitely want to be involved in tobacco because of the impact those two things have made on my family. How do you do those filters fit into your ESG portfolios?
They definitely do, and we will speak to clients, we'll conduct research, we'll use third-party research as well to understand these themes and what's important to investors. Bearing in mind, we have, I think, in total 30 million customers globally, so we can't take on everybody's point of view, and we can't build a bespoke product for everyone, and that's not how we approach things. We really want to have scalable products, because then we can lower the cost of them, and there's a big, powerful incentive to help people pay less for their financial services, because it's a better outcome for them. So we try to capture as many people as possible, but we admit that we're not going to please everybody, and we're not going to create small bespoke products for everyone. But there are certain things that come through very strongly. One of them is tobacco, and tobacco screens have been around for quite some time now. Biological weapons, nuclear weapons, cluster munitions, cluster bombs. Some of these things actually have been around for some considerable time. What's happened more recently is that ESG has become a sort of umbrella for a number of these concerns, rather than in the past it might be the Church of England would come to an asset manager and say, well, we want to invest some of our assets, but please don't put it into gambling stocks or alcohol or tobacco stocks. That idea of investing has been around for a while. It's just maybe the broader umbrella has kind of really captured all of them now. And so this is why we have to be quite careful when we use the term, is what exactly are we talking about? Yeah.
And of course, I don't know where the filters finish and start, but I can imagine that maybe British American tobacco doesn't fit into the ESG kind of gambit, but does a retailer like I don't know, I presume they still sell them, but if I went to Sainsbury's, I think I could probably buy a packet of cigarettes. Does that, because they're retailing tobacco, does that preclude them or include them?
Yeah, it's a really good point, and a great deal of thought goes into this when creating products. Actually, this is one of the key questions, which is how far down the chain do you go? And we have this a lot in the States because of the availability of weaponry there. So do you exclude weapons makers but include Walmart, who sell lots of weapons and ammunition? So similar, it's not such an issue here in Europe and in the UK, but it's very similar to your tobacco example. So what we would look to do with the products that we've created is filter out the producers. So those involved in the manufacture, the growing of the tobacco plant, the actual production of the cigarettes, but also if we have a paper manufacturer who determines and raises a lot of revenue through the production of the filters, for example, then we'll take those out because they're a significant piece of the puzzle. But this gives you an idea of, it isn't just as simple as us saying, right, okay, VAT, let's take them out. It's okay, let's look at the paper producers, let's look at some of the big agricultural companies. But what we've realized is, and although you can find solutions that maybe would take out the retailers, what we found from our sort of research is that our investors typically don't want to be that extreme. They don't want to inadvertently take out Tesco and Sainsbury's and some of the other large retailers, because that's not really what they meant when they were thinking of exclude tobacco. However, there are some individuals who may want to go down that route, but what we would caution there is if you become very extreme and follow these things to the nth degree, you could end up with a very small portfolio of stocks, because there's the banks that finance these things. There's the trucking and shipping and haulage companies that move the cigarettes around. It's almost endless if you really think about it. So you have to draw the line, because one thing we are conscious of, particularly from a Vanguard perspective, is going back to that diversification point. We want highly diversified funds, because that spreads your risk and your exposure to any one company. So we don't want to create a company that ends up, a portfolio that ends up with 20 stocks, because that's not the way we approach things. But also the risk you're then taking on is quite substantial, because if you just take the UK, you've got the all share with several hundred portfolio constituents, the all share index made up of UK listed companies. If you filter out too many and you end up with a very concentrated portfolio of 10 or 20 stocks, that's going to have a lot of active risk. And you're then introducing a whole lot of risk and volatility that perhaps the individuals who are buying these products didn't realize or didn't actually want. So the issue, as with all things ESG, is it's balance. It's a balancing act.
Yeah, absolutely. So let's just touch on that for a second. So in my global portfolios that I currently run, which have predominantly got yourself as a fund manager and another company called Dimensional, who will be known to our listeners if they've listened to some previous podcasts. And you guys are both as fund manager and asset managers are known to be well-diversified portfolios, to keep your costs down, to minimize trading and fees. And you obviously do that by also not having shareholders that you're not having to pay dividends to. So if we look at, I think at the last kind of monthly meeting, investment meeting we had here at MFP, we had about 11,500 different equities within our global portfolio. Now that's hugely diversified, of course, and they're also spread across the world. If we looked at I think you've got a recently newly launched ESG fund on a global basis. How many? I mean, I'm not going to hold you to this, but how many kind of companies would you hold within that, do you think?
Yeah, it's a good question. So, as you say, we launched two products recently. We launched a global developed markets ESG equity fund and an emerging market equivalent. The idea being that investors can then put those two together in proportions that suit them and effectively get a global equity exposure. So if we take the developed world example, it's all cap as well, so small, mid and large, which again is important because some products are just large, some are mid at large. We wanted to go across the spectrum so that we again get the benefit of diversification. The parent index, should we say, the non-ESG universe for the developed world all cap, in this instance, is around 5,600 stocks.
Right.
Now, once you apply the filters, you lose around 800 of those securities. So say you end up with 4,700, 4,800. It will depend because the number of companies in the overall index changes from quarter to quarter. But that's the sort of level you're looking at, sort of losing 800-ish from 5,600-ish. Right. Now, what does that mean? Because it wouldn't be very diversified if that meant, you've just dumped all the smallest stocks. Actually, what it is it in aggregate represents about 20% of the index. So we're removing exposure to about 20% of the broad universe. So you still get great diversification. You're spread across countries, spread across the caps, small, mid, large. And you've got a large number of companies in which to invest in. The other thing that brings is often overlooked is liquidity as well. That means you're not going to get into trouble with trading these portfolios because there's 4,600, 700 stocks across the world. That's trillions of dollars of underlying exposure. And that's something that's important to us because some of our products do grow quite large. So we want them to be liquid and tradable and cost effective, essentially.
Yeah, absolutely. And I suppose for investors getting in, investors getting out, then that liquidity, of course, is hugely beneficial to them.
Mm-hmm. Yeah.
So now you are, I mean, you're known for different things, and obviously America being the home of Vanguard, but when you launched in the UK, you are a big what we call a passive manager, so that you track indices, and you track indices at a very low cost, so you provide huge value to the investor. What's your approach to ESG? Is it an active stance where you're picking and choosing which company is going to outperform the other, or is it a passive approach?
Yeah, at the moment, it's predominantly an index or passive approach, which is where the portfolio manager will track an index.
Yeah.
Now, we've worked in this instance for these examples with FTSE, a familiar brand, aligned to the FTSE 100, for example. So we worked with them, and they have an ESG series, call it like an umbrella series. And from that, we can work with them and say, well, our investors don't want tobacco stocks. Okay, that comes out. Our investors don't want, gambling stocks, etc., etc. And then you come to an agreement with, this is the shape of the index then, and we look at the characteristics. Is it diversified? Is it liquid? Is it doing what we think it needs to do? Is it too ESG, too screened, or not screened enough? And then, once we've determined that, agree that with FTSE, and then our portfolio managers will build a portfolio that tracks that index. So it will actually deliver the performance of the index. Now, it's interesting you mention active, because what we would say is in certain parts of the market, you may well be better off being active. So to give the example I used earlier, if someone has very, very powerful beliefs and they want very, very specific bespoke requirements, that's where an active fund might come in, because an active fund manager can then be that specific. But of course, then you're taking on board all the risk that goes with choosing active strategies. And so you must always make sure that you know what you're buying and you understand the risk you're taking. But the biggest destroyer actually of returns over time, and all the academic literature will show this, is how much you pay for something. It's very simple. If every pound that an investor gives an asset manager to manage that strategy, that's a pound off their return. And that compounds over the years very powerfully and becomes very large. So you really must, when you're thinking about this active index debate and within the context of ESG, how ESG do I want to be? You've got to focus on the costs. You've got to understand what you're buying and then think about the risk.
Absolutely. Wise words. So, Mark, what I'm interested in is a couple of companies who are obviously in the news, and you may know and you may not know the answers to this, because I appreciate you're not putting the portfolios together. So I'll give you a get out of jail if you don't know the answer. But so for I'm going to say Apple. Apple are huge. Do they make the grade?
They do for the indices and the products that we've launched. In actual fact, we did look at that because, again, there can be quite subjective choices. One thing that is perhaps unclear to those outside the industry is a lot of the data that gets used to make these ESG decisions, it's self-reported data. We're not yet, certainly globally, from a regulated perspective, we're not at the point where companies are told these are the mandated standards that you must apply when divulging your carbon intensity or your carbon footprint, for example. Now, the world is moving that way. Regulations will tighten up, but a lot of it's self-reported. And at some point, someone has to make some sort of subjective decisions, or look at the GESM's subjective issues. For Apple, for example, given the stellar performance of that stock and the size of it over the last few years, any investors invested in broad portfolios that don't have Apple will have struggled, quite frankly. Because, and the same would be said with, Google's parent Alphabet or Amazon, those familiar tech names. And on the face of it, they seem much greener, shall we say, than BP or Shell or British American Tobacco, because they're tech firms. They don't dig up fossil fuels, etc. However, others might say, well, actually, the tech firms are encouraging this overbuying of technology, and that in itself is an issue. The redundancy that gets built into phones, which means you constantly need to update your phone and upgrade it. Is that an environmental problem, potentially? And what is maybe a company like Apple? What are they doing about that? The other thing is gambling. If you take a very strict line on gambling, you might say, well, mobile devices have actually enabled the growth of online gambling and therefore gambling problems.
Yeah.
So there's these indirect things that do crop up. Now, when we looked at Apple in particular and the other tech firms, we determined that, again, we didn't feel that it was right to create screens that were so strict because of, say, gambling or overproduction of technology, that the big tech giants would not end up in the portfolio, because we didn't think that's what our investors actually meant when they said, deliver me an ESG product. But again, I must stress, there'll be people listening to this that would say, oh, absolutely, I don't want to be exposed to Apple for these reasons. But, we have to make some decisions and try to come up with a systematic way. The other thing is, what we try to do is make it clear and transparent. Look, this is why something would be excluded. These are the criteria. And we try to shine a light on that as much as possible.
Yeah, and of course, a customer or an investor can then make an educated decision. No one's forcing them to go down the ESG route, and and other providers are available who may take very much more specific kind of views, maybe stricter criteria than yours. But then, of course, we probably get a much narrowing range of investable assets. So everything has a yin and a yang, I suppose, isn't it? We have to balance off every question that we're looking at when we're looking at ESG.
Yeah, and there are some, broad guidelines that you can follow, and we've talked about many of these buckets. It's often not controversial to say, take out tobacco production. Everyone has been affected by someone who's been affected through smoking and the things that can lead to. Alcohol, if you're thinking in an ESG from an ESG perspective, taking out the big alcohol producers and the production of that. And then, as we mentioned earlier, biological weapons, cluster munitions, indeed, they're illegal in many countries in the world, but not all. That's the other thing. So there are certain parts of the world that have a totally different view on these, but there are some big buckets that most people, at least in our research, can agree, okay, these are kind of all abhorrent things from an ESG lens, let's remove them. And then, as you say, if there are other investors out there that have very specific requirements, it's like anything in life, well, then they may need to go and find a bespoke provider for that. Sure.
So just returning to the kind of companies you invest in, the other one which I'd be interested to know whether makes the grade would be Tesla.
Tesla, yes, that's a great one. It's a real Marmite stock, isn't it? In our experience, people love it or they hate it. I actually, off the top of my head, I'm going to plump for that it's in the index. The reason I'm sort of a bit reticent is because Tesla's quite complex. The S&P 500, for example, is a very well-known, big, popular US index. But Tesla's not in it because to be in it, you need 4 quarters of growth. It's got nothing to do with anything to do with what the company produces. The Dow Jones is another famous, often quoted on the news, US index. Tesla's not in that because its price is too high. And there's a quirk of the index that means if a stock has a high price, it can't be in the index. It's bizarre. So Tesla's quite an interesting one. Now, we work with Baillie Gifford, a well-known Scottish active manager that had actually stellar performance this year because of positions in companies like Tesla. Now, they're actually the biggest holder in Tesla. But there's a US hedge fund manager who holds one of the biggest short positions, i.e. betting on the price coming down in the US. And so you can find totally polar views. Is Baillie Gifford right by being the biggest holder, or is this experienced hedge fund manager who's made billions shorting companies right on Tesla? They're both very intelligent. They both do lots of research. I'm sure they've put up a great debate, but who's right there? And so when we think about it through the ESG lens, the reason it's a good example, actually, I'm glad you mentioned it, is that from the environmental side, we can all say, okay, I get that. Electric cars, lowering emissions, that makes sense. Big battery production. Yeah, okay, I understand that. But then equally, it's hit the headlines multiple times because of tweets from, certain individuals in the company. And people might look at it and say, corporate governance-wise, is it, a strong sort of case in great corporate governance? Would you say it's got a shining light on corporate governance? So how do you weight those two things? If you're creating a score or a view on Tesla, does its battery production and its car production outweigh some of the corporate governance concerns? For some people, that will be the case. Others would say, oh, no, because we know well-run companies ultimately deliver shareholder value over time, or are more likely to. So this is the issue, is that even when you take one company and then you break down all the factors, you can get completely divergent views and scores. And so this is why it's really not simple to put these things together and say, company A is a good company, company B is a bad company. It's really tricky.
Yeah, absolutely. So here's a slight curveball for you. Would Vanguard make the grade?
Yeah, it's an interesting one. Would they? I should certainly hope we would, because essentially we are an investor client-owned business, and we would score very highly on the S, which is looking after the people that work here. That's a very big issue within Vanguard, that we want the people that work here to be healthy and happy and contribute, and et cetera, et cetera. And it's very, very important to the company, because ultimately, high staff morale and productive staff result in a better outcome, whatever you're producing. So it's at the core of the company. The thing is, because we're not listed, because we're private, essentially owned by our clients, we are not captured by these ESG metrics. So I'm not actually sure how we'd come out. I would just hope that we would come out as a positive voice.
Well, environmentally, I presume you're not burning huge amounts of oil.
Yeah, exactly. Yeah, and interestingly, I think if you look at what's happened in COVID, we've got 17,000 people working from home. Yeah. And that's the company's been very supportive there, sending the technology home and making sure people are comfortable and have everything they need. But yeah, we're not out mining thermal coal or producing biological weapons or anything like that. So I would hope we'd score well.
Fantastic. So Mark, where can people find out more about Vanguard and the ESG funds that you offer?
Yeah, there's actually, we have information on our website. Some of your audience may be aware that we have a direct retail offering. That means, you can come directly to us and purchase the funds. And there's a very sort of straightforward website, actually. We don't go in for, bells and whistles and fancy things. It's sort of plain and straightforward, because with finance, you need to get to the point. So you can buy it direct, or you can buy it through platforms, the funds rather. And again, we'd always say, make sure people take advice. It's incredibly important. Our own research and working with thousands of advisors has shown that there's a tremendous amount of value that can be got by taking sensible financial advice when you're making any decisions.
Brilliant. Well, I'll put all that information in the show notes on the retirementcafe.co.uk website page. So thank you once again, Mark Fitzgerald from Vanguard.
Thank you, Justin. Thanks very much.
Thank you once again to Mark for taking the time to talk with me. To find out more about ESG investing and Vanguard, check out the show notes on our website at theretirementcafe.co.uk, where you will find some useful links. One of those links will be to my conversation with Neil Cowell of Vanguard, if you're interested in finding out more about the company itself. I'd also like to remind you that I will be welcoming Professor Andrew J. Scott, author of The 100-Year Life and The New Long Life, founder of the Longevity Forum, to celebrate the 100th episode of the Retirement Cafe podcast on the 6th of October. So to be sure to subscribe either on our website or your preferred podcast player so you don't miss it. Thank you as always to my financial planner, the Fixed Fee Retirement Planning Specialist, for sponsoring the podcast. You can find out more about how they can help you bring clarity to your retirement at myfinancialplanner.co.uk. If you have any feedback or suggestions for podcast guests, please drop me an email at hello@theretirementcafe.co.uk. And of course, if you've enjoyed this episode, you can write a review, please, on Apple Podcasts. So until next time, this is Justin King, helping you feel more informed in your retirement.
Thank you for listening to the Retirement Cafe podcast with Justin King. To find out more, you can find us online at theretirementcafe.co.uk.